So what's up, guys and gals? Welcome back to the Easy Profit YouTube channel. Now, I've been gone for a couple of months, but in those months, I've seen that day trading has become so popular that now it's dangerous. It's dangerous in the aspect that a lot of new people have been popping up, talking about trading with no real long-term experience. And in these very, very short-term markets, they found success, but there's a lot of misinformation that is being spread. This video here is probably going to be one of the most in-depth and most important videos that I make, because I just want to just show it all. When it comes to trading, what do I do? How do I execute? What am I looking for? Just all the analysis and everything that you need to really start to replicate these strategies, and not really replicate, but understand what to do. I want to just reveal it all. So this video is going to be long. It's going to be jam-packed with information. If you guys like more videos like this, please give a like, subscribe, and let's go. So let me preface this video by saying that I won't be going over very, very simple concepts. So if you want to know what a stock is or what a share is, you can just Google it. If you want to look at my older videos of some of the very simplistic concepts that I go over, you can look at that as well. I always tell my students this, that you watch all my older videos, you can get the basic information. So especially with this video, it's going to be a little bit more advanced. You can kind of jump to this video without a lot of hiccups. So just a little fair warning, this is going to be a little bit more in depth. So to really just jump into everything, I just want to give a good background of my trading style. Now, you're going to know that I don't trade very, very super quick price action. So I'm not the type to really scalp positions, have entries and exits that fall within 1 or 2 minutes of each other. I try to usually hold, and usually my average hold time is between 5 and 10 minutes. So that's really a good average of being able to grab a nice meat of the move, rather than playing the fortune teller route, trying to say, okay, what is it going to do an hour down the road, 30 minutes down the road? Because different setups lead to those different outcomes. So if I'm looking at a very short-term setup in the morning, I'm looking for a red to green move, some form of pop to develop. A lot of times I just want to play the hype that develops once a crossover develops like that, play it, and really jump out. I'm not looking to see if it can run another 20 or 30% down the road and hold it throughout the day and hold through a lot of BS sideways action that can develop. So number one is where I want to start at is building your watch list, knowing which companies to focus in on. So traditionally, what I usually look for is percentage based. Percentage based is one dimensional. That's the easiest route to go after. So if you are scanning in the morning, let's say you're scanning before the market opens, let's say for example, for us, I'm living in Texas, so the market opens at 8:30 a.m. Central Time. So if I'm looking at the markets at 8 a.m., 30 minutes before the market opens, any percentage that I see is going to be attributed to a certain gap up that is developing. So a 30% gap up, a 26% gap up, a 13% gap up, whatever the percentage is, that's going to equate to some form of move that is developed in the pre-market or after hours that is causing that gap move to develop. Now, the higher percentages are going to be more attractable, like there's going to be more attraction to the masses to those, because they've shown that they have the ability to move in percentages and accrue value much quicker than others. Now, there is a certain downside. There's a yin and yang with everything, and that's kind of the overwhelming concept you're going to see within everything I talk about. The yin and yang is going to be that the further that they gap up, usually they're going to be having a higher tendency to crash out of the gate. So a company that may be up 10 or 15% overnight, it may trade very sideways out of the gate. A company that's up 40 or 50% or maybe even 100% overnight, then once we get out of the gate, there may be a very, very flash dumping that happens. A lot of people liquidating shares from swings or from pre-market entries that they've taken, and it becomes a lot of times like a minefield. That's why one of the rules that I always have, waiting the first 5 minutes out, I still hold that to this day. So if you want to develop a watch list, depending on the platform you use, I use Thinkorswim. This is like the standard for me to trade with. There's a lot of different platforms out there. They all work really the same way. Even with a scanner, if you use FinViz or if you use Trade Ideas, it's the same values really. When it comes to a maximum of price, let's say we're on the price subject. The maximum of price is purely on a affordability level. So what can you afford? If you can't afford trading above $10 per share, then trade below that. You still always want to grab an ample amount of shares. You don't want to be trading a $300 stock and only buying 5 shares. I still like to have a nice share amount that I've grabbed. So rather than trading a $300 stock and buying very, very minimalistic single shares, might as well buy more shares of a cheaper company. So as you grow your account, as you make more money, yes, you can open up the maximums. But mainly the maximums are only there purely for a cost basis. What you're actually going to find, and a lot of people won't tell you this, is the higher price companies do trade better. That's just a natural fact of the matter. Now with the minimums are very important because when you get into such lower price, you start to fall into different markets. So whenever you go below $1 per share, a lot of these companies are having the risk of being delisted from the NASDAQ, or if they've already been delisted, now they're trading on the OTCs and pink sheets. So the OTCs and pink sheets back then, especially when I first started, they were very, very hot. There was a lot of opportunity there. Now, not so much. It's just purely pumps. And just, if you think about, if you ever heard of like the Wolf of Wall Street, like Jordan Belfort, all they used to do is just pump pink sheets and crappy companies and things like that. So that market still has such a negative connotation that a lot of investors completely avoid those altogether, only want to trade the NASDAQ. So when you're trading companies above 50 cents per share, you're mainly staying in the NASDAQ territory. If you ever want to specifically do this, you can always on Thinkorswim go to the exclude tab, go to category, and go all OTC stocks. So you're not going to see any OTCs pop up. Everything here is all going to be NASDAQ based companies, which is going to be a little bit easier to trade with. So if I'm developing a watch list now, you want to sort by the largest percentage gainers going to the weakest. Now, not just the percentage gains, for example, you want to detail volume, you want to detail the bid and the ask, and you also want to detail the float of a company. All of this is going to factor in to where I want to rank companies over the other. So if I'm looking at GNUS, for example, this company has right around 33% in gains right now with 60 million volume. That's a very, very solid candidate to put on a watch list. Now, if a company that is slightly below it has more volume, or a company that's slightly below it has a lower float, for example, I may rank this company higher because it is showing more interest. So where it comes with percentage gains just by itself, if I look at volume is a sense of activity. The more volume a company has, the more active it really is in that area. I usually have minimums of 200,000 in the pre-market, but I will move those minimums up to 1 million once the day actually opens. So with that volume minimum, early in the morning, if you see a company that has 1 million volume, that's very attractable. Now, if you're towards the end of the day and a company only has 1.5 million volume, it had 1.5 million volume accrued throughout the full day, all of those hours of trading, and it only gained that much volume. A lot of times those are going to be very, very dead candidates. So it's still situational. If you're looking at and trading within the first 10 minutes of the day and the company has 1 million or 2 million volume, yes, definitely focus in on it. Once you're towards the end of the day, a company that only has 1 million volume, it's very, very unattractable. Now, I'll look at the spreads between the bid and the ask on certain companies. So especially on a watch list that I'm trying to build, if I'm looking at the top 4, what I'll do is I'll look at the spread between the bid and the ask. So if you look at that difference between the bid and the ask price, the nearest buyer's price and the nearest seller's price, that kind of shows you how liquid the company is to a certain degree. So when you start to have lower volume trades, a lot of times those spreads open up. You can see all these trades here with a lot of volume, they have really 1 penny spreads, 202 to 203, or 203 to 204, 214 to 215. Now, once you get into this lower volume stock here, you can see that the spread is 987 to 993. There's much more room there. The spreads are going to be dangerous in certain levels, especially if you're looking to buy and sell in a very quick manner. You want to jump in and jump out. A lot of times when that develops and you want to have a very quick turnaround, you remember, if you want to buy quickly, you buy from the nearest seller, which is the ask. If you want to sell quickly, you sell to the nearest buyer, which is at the bid. Whatever that difference is in price is how much you're going to pretty much scam yourself out of. So if I have a 1 penny per share spread, I only scam myself out of 1 penny, which is a lot of times on 1,000 share. What's that, $10 or so? It doesn't really affect me at all. Now, when it comes to having 20 cents in spread or 30 cents in spread, then that really takes effect, where now I may be stuck into the trade until the spreads tighten or until the bid prices start to go a little bit higher. So it's one of those things that you have to understand, that spreads are going to be a byproduct of low volume. And it's one of those things you always want to keep your eye on. The third thing here, actually would be fourth thing. because you have you have percentages, you have volume, you have spreads, and then you have the float, the share amounts that these companies are built out of. Floats are important because floats are going to show how reactive these companies can be. The lower the float, the more reactive it can be. Think about it of a pool of shares, just a pool in general. A pool that is millions of gallons versus a pool that is only thousands of gallons. If I poke a hole in it, the pool with millions of gallons is going to take a long time for it to bleed away. Pool with maybe a couple thousand gallons, it may take a very, very short period of time for it to bleed away. So essentially, the smaller the pool, the quicker we can run up prices positively and negatively. So it's going to be much more reactive. So if I see a company that I'm looking as a watch list that has a very, very large float, let's say, for example, we're looking at this company here, GNUS, much larger float here, I may want to prioritize a much smaller float, let's say RETO, for example, because the smaller floats means that it's going to be much more reactive whenever volume starts to pour in. It's not that these larger float companies won't run. It's just that whenever you do get volume, you're going to have to wait on your targets to be met. You're moving a mountain rather than moving a hill. So really what I'd like to do is try to prioritize lower floats. I have a perfect range right between 5 and 50 million. When you get below 5 million, those are dangerously low floats. Those are like those micro floats. That problem arises where if it's too reactive, a lot of times your entries become delayed because whenever volume hits, the prices just shoot through the roof. It's damn near impossible to grab a nice entry into a position. The larger floats take much longer to reach your targets like that. So it's almost situational. I find the sweet spot for me is between 5 and 50 million. So this is really what I would do to build a watch list. Just go down the list and try to grab the top 4, see which ones, for example, sometimes you may have a candidate like this that you don't want to add into your watch list because obviously even though the percentage gains may be there's not enough volume available for that company. So you kind of want to look at all of that in detail. Weight all these things together, look at the spreads, look at the floats, see which is the best candidate to start to focus in on, and then go from there. Now, one of the most important things that you're going to see in this video is what I call bias. Knowing which side to play in an event that you want to take a trade. Knowing which side has a higher probability of winning. Now, understanding probabilities means you need to be tracking trades. You need to understand what you've been doing over the past and seeing trends and seeing connections in that area. So if you see that you're more likely to be correct going long in a certain area, more likely to be correct going short in a certain area, that can help develop a bias. Now, there's really 3 specific biases that I have on any trade that I look to now go after or I'm interested in. So if I see it on the watch list, it's starting to take off, it's starting to move, or let's say if I see it in the pre-market and I'm waiting for the day to open, then I start to look at these 3 different biases. Number 1 is the news bias. Okay, what is causing this run up to develop? What is the catalyst? And how is it poised in the market? So if I look at NNVC, there is obviously that keyword here. I don't want to say it because, YouTube and monetization, but there's that keyword that is obviously, you see highly effective, these buzzwords inside of the news report. So this is going to be something that is positively biased in the news report. So this is positive news. Positive news usually, and I always want to say usually, it doesn't always happen. Positive news usually means some form of rise in price. Now, will it be a rise in price in the intraday? Sometimes that has yet to be seen, but usually in the pre-market, we're going to see some form of rise in price and some form of action. Like I said previously in the watch list, the higher percentages that you see of a gap up forming usually means that there is a higher tendency for sell-offs to develop during the day. So even though these are more enticing, they also become more dangerous. Now, the secondary bias is I have a historical bias. Okay, what has been happening in the past history of this company to really give me some form of directional bias, for example. Historic bias is a little bit more vague because a lot of times these companies are doing actions that they've never really done before. So, for example, you can go off the history of this company, but it may not inject into the intraday as cleanly, but it's still something I want to look for. So from a historic standpoint, from the last 3 months or so, this company has been uptrending to a certain degree. Which shows a little bit more of a bullish push that is developing on this company. Now, another way I can look at it too is looking at historical instances of this same event. So if I look at this event as being a gap up that is developed, if you look at here on March 1st to leading to March 2nd, there is a gap up, let's say somewhere around the close of the previous day to the open of that day, right around 94%. A 94% gap up that has happened in an overnight early morning standpoint. The last time that has happened to that strong of a degree, we could detail it somewhere here, maybe even somewhere here. So you can see that a gap up has developed in that same way, where it has moved damn near 40% overnight, not as strongly, but the same kind of development that has happened. Now, historical instances are going to show you whenever that company is pushed into that uncomfortable level, what is the outcome? And you can see that on this instance, the last time that it had gapped up to a very large degree where a lot of volume flooded in during the day, there was very, very heavy sell-offs that developed. So sometimes that may lead you into the day that you're trading where there is going to be a possibility of that repeating itself. History does repeat itself, but it's not going to be as cleanly as like larger companies like Facebook and Amazon and Apple and things like that. These are the no-name companies that stay dormant literally 250 days out of the year. And for those 2 days out of the year, they may get hype here or there. So it's not going to be the same way. So on a historic bias, I may say that this is neutral. Even though it has an uptrend in the recent history, the historical instances of this same gap up usually show me that this company is falling. So this really doesn't help or hurt me in the historical area. Now there's going to be a trade bias. So the trade bias I have, it depends on my track record and what I've seen in my own trading, where I should be biased at. Now, you don't develop a trade bias not until you have a track record of trading. So you traded 10, 20, 30 different stocks, hopefully more, because the more trades that you take, the more resolution you have of that information. The more trades that you take, and you see that, okay, I win more if I go long in this area, I win more on the short side if I go short in this area. That helps to develop a bias. So once the company actually develops that instance or that certain that instance, for example, then you can jump on and be able to be in the higher probability areas. So usually where my trade bias comes from is I find that in my past trading, I am more likely to be correct if I go long whenever the companies are green on the day and whenever I go short when the companies are red on the day. A very, very simple setup here. So if we look at the day that this company is gapped up, you can see that this is on March the 2nd. So if I look at from March the 2nd and I detail the opening price during the day, which is right around 8.2 here, if I draw that line, it's going to be able to show up throughout the whole day. What you're going to find is anytime I'm looking at this company that is above this level, above this opening price, it's technically going to be a green candle on the day. Anytime this company is below this opening price, it's going to be a red candle on the day. Now, over my track record, I see that I'm more biased to go short whenever I'm below this level. So if this company dips below this point in reference, I'm going to be more correct if I start to bet against this company. Now, your bias is very fickle. So for example, your bias isn't going to be shared with everybody else. So even though you're playing probabilities, there's also going to be the other side of the probability that you lose. So for example, if a squeeze starts to form, you need to be able to be quick on your feet to say, okay, I am wrong in this area and I should cut the trade, or maybe I should look to break even. This is one of the most dangerous parts about people having certain biases is they never flip the switch. They never can prove that they're wrong. Bias, to a certain degree, enforces bad habits to say that, oh, I'm very correct when I go short, so I should stay short throughout this full trade. And then whenever it does squeeze, you never jump out and you have the risk of losing a lot of money to a certain degree. If you say, oh, damn, I'm down X amount of dollars, let me cut the trade up here at 8.4, it ends up coming back down to a break-even point. If not, you made profit. But now that you've taken so much room to lose money, you may lose $500 on the upside rather than flipping your bias and saying, well, now that I'm getting squeezed out, let me cut the trade and break even, let's say only lose $200, and wait for that action to happen again. And once it happens again from green to red, or that crossover there, you can reshort it, make that loss back, if not make even more. So you don't always nail it on the first time that you look to trade. This is one of the things that a lot of people that are under the PDT rule, they don't understand that sometimes it may take 2 or 3 different entries to build a profitable trade. And since they're under the PDT rule, they want to minimize as many trades that they take as possible. A lot of times they want to do everything in a fatal swoop. They want to short here and they want to hold it down for the full day. And even though that's admirable, that may make a lot of percentage gains and you can throw those profits on Twitter and it look good and it'll run, you'll get retweets. But at the end of the day, you're going to have to hold a lot of times to a lot of BS, and you have to open the lines of how much you can lose. And usually that means that whenever you do lose, you're going to lose a lot of money and you can no longer maintain that risk to reward ratio where you make X amount and you only lose half of X amount. So if you're normally gaining $500 per trade, you want to lose $250 per trade maximum. You're no longer to keep that ratio anymore if you have a bias that you aren't able to flip. So in simplifying all this, you're going to have a news bias that allows me to see what is causing this type of upwards mobility in the stock, and hopefully it's positive, which is going to lead to a lot of times a positive movement in the stock. Make sure you know where that positive movement has happened. If it happens in the pre-market or after hours, a lot of times if it goes too far or runs too far, it doesn't leave enough meat on the table for the rest of the day. Then there's historic bias, where what has been happening in the previous history of this company. In recent history, you can see there's been an uptrend developing, but also in recent history, or in a historical sense, this company has gapped up previously before and crapped away all its gains. So maybe the next time it does it, it's going to do that again. So there's some historical instances that I can base my trade off of. And then there's the trade bias, which is if I look at my past trades and look at my tracked trades, I can see that I'm more likely to be right in a certain direction. If I go long as it's green on the day or go short as it's red on the day, I'm more likely to be correct in those certain areas. So now you only want to pose your trades in those little sections like that. Now, the problem with trade bias as well is some people become so trade biased that they're not able to flip the switch and call it whenever they're wrong. So if you ever are biased towards a short side and as it's going red on the day, you look to short it and you're making some money. If it ever chooses to squeeze for whatever reason and you don't cut that trade while you're either at break even or while you're down a couple dollars, you can easily lose a lot more money because you always want to be correct. And you have to know that you're not always going to be correct. So in the times that you're not correct, how do you cut those trades? And that's really what we're going to get into now when it comes into the live examples. How am I cutting my trades? Where am I taking my profits? Where am I entering and where am I exiting? So this is more of the concept. Now we're going to show the actions that go behind all. So this ticker here is JE. So this is a trade that I took before. And if you look at the pre-market, obviously you can see some form of instance of like an ascending triangle developing. You have a very solid resistance right around the $4 per share level. Now, what you have to realize is when it comes to trading in the morning, a lot of action happens very quick where the turnaround is going to happen very, very quickly. So whenever I wanted to take this trade, obviously this was front side. This was very, very bullish in a trade, especially breaking and surpassing the pre-market highs, and especially the $4 per share, which is a whole number psychological point. Now, where I actually took the trade is on the pullback. I like placing my entries as close to moving averages as possible, like my entry here, right around the $4 per share level. So I like to get entries on the pullbacks when they pull back to moving averages, because now I'm looking to play the bounce that is supposed to happen next. So I have something to look forward to. If you ever just chase stocks on the upside, a lot of people do this in the morning where as it starts to pop, they look to chase. If I would have chased this company as it was going upwards, and let's say bought it like 4.1, 4.15, I wouldn't be able to hold this pullback that develops all the way down to damn near the 380s. And that would have probably kicked me out of the trade, causing a loss, and me selling it early before it actually looks to pop again. So that's my goal, is to buy it cheaply near the moving averages, have enough room to hold that and for the next pop to develop. When the next pop develops, the next rush of buyers want to flood in. Obviously, it's still bullish. It's still green on the day. And once that happens, I sell into that next run up. So you can see me here looking to set my sell orders, trying to find a place to really execute some form of exit. The main thing here is the mistake that I see here is setting exit orders that are the high of the day. The high of the day is going to act like resistance. So if you look to set exit orders at the high of the day, you have a good chance of getting that deflected. Now you start to see that I kind of understand the wrongs of my ways, and I start to try to move that sell order downwards a little bit more. Sometimes I get greedy. I may want to keep it at a certain area, but that's kind of the main thing when you look at it. You can still see that company is green on the day, keeps on pushing even higher, but that's really what I wanted to do. Now here's the ticker AACG. Now I actually took a loss on this trade. So you can see it developed just like the previous stock, where right out of the gate, a lot of upside movement, breaking pre-market highs and things like that. Now the problem is I end up buying in some of the highest areas of the VWAP. So when it comes to volume weighted average price, you have those three distinctive levels, and I'm buying at some of the highest. And the problem with that is you're have a higher tendency to not be able to hold through any natural pullback. So if you see a pullback develop like here, moving a little bit further downwards towards the moving average, if that ever develops in the meantime that I'm in that trade, by me buying in the higher areas of the VWAP, I have a highest tendency to end up selling early and getting especially just kicked out of the trade out of fear. So especially if any very strong red candle develops, I'm gonna panic, I'm gonna jump out. If not, the next candle, obviously you can see here, starts to work its way back up. I end up rebuying in and to make back some of that loss. But that's really the big issue here is when you start to play any type of upside moves and you're riding that wave on the upside, your problem usually going to run into is whenever the pullback does develop, you're going to most likely fold. So I think the best area for me to fix this trade into, I mean, hindsight is always 20/20, but it's whenever that pullback does happen, then strategizing an entry from that point, like I did previously on the other stock. That was a better comparison to actually a good trade than this one. This is something that in certain instances, me being experienced, yes, I can make back some loss, but it's not something that everybody can do. So the main thing here is just don't chase the upside. This is the problem with chasing companies right out of the gate. Whenever they choose to fold, you're going to take a very, very quick loss no matter what. Now here's another trade here on VCNX. Now at this point you guys might be saying, damn Jay, you just trade the same thing, you trade the same setup, and that's really the goal. The more times you trade the same setup, the better you are going to be at it. It's just like practice. Now obviously out of the gate, very, very bullish activity that is starting to run, starting to take off. Obviously I don't want to trade within like the first candles of the day, and especially seeing those very, very highly wicked candles like this, those become very, very sketchy opportunities like that. Now I end up grabbing some shares in the 650s. Now this was a bad trade that turned out to be profitable. The way that is a bad trade is because I can automatically tell that since my entry is at 650, where do I draw the line where I want to exit if things go wrong? Most likely if things went wrong, I'm going to end up looking to sell it either at or below the open price, the differentiation of green on the day and red on the day. If that was to happen, I would end up losing damn near 10%. So this was a very, very chasey trade that I end up taking, but it ends up being profitable in the end as people kept on piling on. So this is the big lesson here is mistakes don't always show up as a loss in an instance. So don't look at every trade as if I won it, it was a good thing. If I lost it, it was a bad thing. There's plenty of bad actions that end up becoming profitable trades. Now, the reason you track your trades is because now you can see those bad actions over time mean that I lose money. I end up selling my shares before they hit 7 and sell the other half at 7 as well. The reason I would choose $7 per share as an exit target is because 7 is a psychological number. That is an area where naturally human beings are going to just look to set sell orders at that point. So rather than playing the Nostradamus route, oh, it's going to go all the way up here to damn near 8, I'm just going to take my shares off at 7 and just call it, because we can always have that hindsight bias to say, if I would have kept on holding, it would have got up to this point. I can do that to any trade. So you don't learn anything with that. the best thing to do is to sell while you're ahead, sell into run-ups. Your exits should be into run-ups. If your exits aren't into run-ups, you are doing it wrong in the long side, to be specific. So if you're exiting into the run-up and it keeps on going even more, that's when you know you had a very good trade. If you sell into a run-up and wherever you sell is the tip top of the spike, you were playing with fire at that point. That's usually how I determine if that was a good trade or a bad trade. So even though this was a bad trade, it ends up being profitable. So you always have to understand, don't make that distinction that green is good and red is bad. Sometimes some red trades means that you protected yourself. So I really hope you guys learned something. I know this was a much more in-depth video than my usual. So I didn't want to just go over very basic concepts of what is a stock, what is a share. Kind of really showing you what the psychology behind everything that I'm doing, why I do certain actions, and breaking things down where it should make sense. So coming forward, I'm going to have more regular uploads. I'm not as busy as I normally am. I'm focusing more on my group, my students, and YouTube. So especially in trading as well. Obviously, that's my full-time gig. So I want to have more regular uploads that are going to be showing you everything, just pretty much every topic that comes up in trading, just explaining it and just showing you the realistic approach of how you can actually do it. So especially going forward, if you guys need any help, anything doesn't make any sense, you can always put it down in the comments below. You can always email me any questions you have. You can go to the website and see if anything you're interested in. So that's really it. I mean, anything you guys need help with, just always keep in touch, and then we'll just go from there. So hope you guys enjoyed today's video. Eat, Sleep, Profit for the win. We're coming back for 2021. We're gonna kill it. I love all you guys. You guys pretty much are the reason I wake up in the morning. So enjoy, and I'll see you guys next time.